Nobody likes seeing red in their portfolio, but what if you could use those losses to pay less in taxes? That's the idea behind tax loss harvesting, a smart, legal way to turn investment losses into tax savings. Tax loss harvesting is the strategy of intentionally selling an investment that has declined in value in order to realize a loss for tax purposes. Yes, you heard that right. You're purposely locking in a loss to help reduce your tax bill. That loss can be used to offset the profits from selling other investments with capital gains or even reduce some of your ordinary income. Let's say you sold one investment back in January, you had held it for over a year, and it had a long-term capital gain of $5,000. Now you have another stock in your portfolio that has a long-term loss of $5,000. If you sell it, you can lock in that loss and use it to cancel out the gain, potentially eliminating the taxes you owed on that profit. Losses are applied in a specific order. First, they offset gains of the same type. Short-term losses against short-term gains. Long-term losses against long-term gains. If your losses are more than your gains, you can deduct up to $3,000 against your ordinary income, like your salary. And if your losses exceed that, you can carry forward losses indefinitely until they are gone. There are different carry forward rules for entities, so please consult a tax professional. Quick example. If you have a $15,000 net capital loss in 2025, you can deduct $3,000 in 2025, $3,000 in 2026, and so on for 5 years until it's all used up. Here's the key. Selling doesn't mean you have to sit out of the market, but you need to be careful of the wash sale rule. If you buy the same or nearly identical security within 30 days before or after the sale, the IRS disallows this deduction. Here's an example of a non-wash sale. You sell your shares of Apple and then purchase a technology ETF that includes Apple as one of its holdings. Because the ETF is not substantially identical to Apple stock, this would not trigger the wash sale rule. Again, please consult a tax professional. Bottom line, tax loss harvesting is a smart way to be proactive with your portfolio, not just for damage control, but for tax efficiency. It won't make a bad investment good, but it can make a bad year less costly. Talk with your tax professional and advisor before making any moves. And remember, this isn't just a year-end trick. With the right timing, it's a strategy you can implement year-round. At Retirement Ready Nation, we bring you real-world examples that impact everyday people. If you find this information helpful, be sure to like and subscribe so you're notified whenever new videos are released. This channel is for informational purposes only. It should not be construed as tax, legal, or actuarial advice. Ashbury Boutique Wealth Management and the Leaders Group do not replace those professionals.